Very good evening to all of you. Welcome to today's YouTube live session. I apologize for a little delayed start. I was having a small little hiccup. Uh, was not able to share my screen, which caused a few seconds delayed. But yes, things are under control now. So let's get started with today's session. Today we will be covering our lesson number 30. And yes, before we start with that, the most important thing, let's get done with the formalities. So make sure you people go through the disclosure, which talks about representation, risk disclosure, risk involved in the market, and also about the copyrights. Right, so talking about today's lesson, it's going to be lesson number 30, which is Iron Condor. We have already covered Short Strangle. So you will see Iron Condor is basically a modified version of Short Strangle. That is what I also talked about when we were understanding what a Short Strangle is. So today we will be building upon that Short Strangle to understand how a Iron Condor is constructed. So yes, we are currently doing non-directional trading. We have already covered directional trading. If this is the very first session you are joining in, then make sure you go through all the previous lessons. The link is available in the description, both for English as well as Hindi language. I'm doing the options course absolutely free. So yes, you can go ahead, start with lesson number 1. If you have some family members or friends who are interested in learning options, you can even share the link with them. If you are on some trading group, that is also where you can share the link to the option course. I'll highly appreciate that. And yes, if you're not registered to my YouTube channel, make sure you subscribe to my YouTube channel. And also, if you are liking these sessions, make sure you hit the thumbs up button, like the video. If you have any questions, queries, feel free to put it in the comment section. I try to answer questions as soon as possible. All right, so we are continuing with our non-directional trading. So what is non-directional trading? Like I have been saying in the last few sessions, that non-directional trading is a style of trading where we are trying to profit from the lack of the movement of the underlying. So when you have an area of supply and demand. So I'm a demand supply trader. So if I have an area of supply and demand and I'm expecting prices to remain range bound in this area till expiry, that is when we can apply this. This non-directional trading can only be done in options. It's not possible in any other asset class. And if you have looked at my Sunday analysis session, you will see when we have demand and supply areas very close by, I keep talking about this, that it can remain range bound for a while. And those are the times where probably we can apply these strategies. So how do we pick that range? I do that by using the proper application of demand and supply methodology. In case you're using, let's say, support resistance, you can do it based on support resistance. If you're doing Fibonacci levels, you can do it based on Fibonacci levels. So whatever your methodology is, based on which you can define a range, you can use that particular methodology. I do it based on demand and supply. So we use options contracts as a substitute for shares and apply option strategy when the script is expected to remain range bound, which is within our areas of demand and supply. And we use the stock or the underlying price to time the options play. So in the non-directional strategies, we started with the Short Strangle. We also covered Short Straddle. Like I said, today we will be covering Iron Condor, which is a modified version of Short Strangle. And in the next lesson, we'll be getting into Iron Butterfly, which will be the modified version of Short Straddle. So yes, let's get started with the Iron Condor now. So this strategy creates again a net credit. So you will be a net seller. You will be collecting some premium, and it is used when we are in section 4. So it's not that you cannot apply it in section 5. You can even apply it in section 5 because you're collecting premium. But in section 5, we do have a better strategy available to us, which is Short Strangle. So that is why in section 5 we can use Short Strangle. But yes, if you want to be on the conservative side, because what happens with Short Strangle is you have unlimited risk. Right now, when we modify it into an Iron Condor, your risk becomes limited. So that is why even if you want to apply it in section 5, acceptable, but ideally we would like to do it in section 4, because what happens is when we try to add the offset units, we are also reducing the Vega. So when we know that our exposure to Vega is really nice when we are very inflated, so the deflation in Vega can pay us really well. So why not to use Short Strangle in section 5? Because if we apply this strategy, the advantage we can get from that Vega, we will be reducing that advantage. So that is what the challenge is. But still, if you want to do it, no problem with that. All right, so like I already said, the application is when we have expectation that the price can remain range bound within our demand and supply areas till expiry. That is where we apply iron condor, specifically when the implied volatility is in section 4. Now, how do we check our volatility section? I have already made the indicators absolutely free. You can go through lesson number 27, where I talked about how you can get access to those indicators absolutely free, and those indicators will help you understand in which section the volatility is as of now. So this strategy should be used when IV, which is your implied volatility or Vega, is in section 4 after reaching very inflated. So it should not be very inflated, it should have been inflated price. There is a potential that it can deflate, which is where we want to take advantage of, but it also has the potential that it can inflate, right? So that is why you will see why we are using iron condor, because we want to have a little bit of protection in case implied volatility starts increasing. So what will be the characteristic of iron condor? Your risk will be limited, your reward will also be limited. Risk will be limited to we will be looking at, you'll be having your break-even points, and you will also be having, because we'll be adding those offset units which will make your risk limited, and reward will be limited to the premium you're collecting. And what are your break-even points? Your call strike plus premium, and your put strike minus the premium you have collected will be your break-even points. It is a delta neutral strategy, and theta would be positive because we are selling options. Time will be our friend, and it will be Vega negative. And how does the payoff diagram looks like? The payoff diagram is something like this. So if you remember, when we did short strangle was something like this, right? Wherein if the prices kept moving down, we were having unlimited losses. If prices they kept moving higher, we were having unlimited losses. But now what we are doing is we are adding some offset units which are now limiting our loss. So in case price it gaps down, we are not losing more than this, and similarly if prices they gap up, we are not losing more than this. So this is how in iron condor we are limiting our loss by adding the offset units. So the way we do that is, first we need to identify our areas of demand and supply within which we are expecting prices to remain. Now, what were we doing with the short strangle? With the short strangle, we were selling an out of the money put which was at or below our demand zone, and we were also selling an out of the money call which was at or above our supply zone. So this is what we call as a short strangle, right? We sell a call, we sell a put, and we collect the complete premium. But the challenge with this was we were having unlimited loss. So now what we do to this is, because these both of them are the anchor units, we add offset units to convert the risk characteristic from unlimited risk to limited risk. So how do we do that? What we do is we buy a put and we buy a call for the protection. So what we do is we buy a put below the put we have already sold, and we also buy a call above the call we have already sold. So by doing something like this, the trade action will be, we sell out of the money call, which is our anchor unit, in this case right here. We also sell an out of the money put, which is our anchor unit, which is right here. And along with that, we buy out of the money call, which is my offset unit, and we also buy out of the money put, which is my offset unit. Now, whenever we are selling options, like I always say, the closer to expiry we are, the better it is for us, because faster the time value will be decaying. And when it comes to what should be the offset unit, we want the offset units should have Vega, which is almost half of the short units. And why do we want that? Because if we are not adding these, then what is happening is your exposure to Vega is really high. And since we are in section 4, because if our exposure to Vega is high and Vega starts increasing, it can hurt us a lot. So we want to reduce the impact of the Vega, and that is why what we do is these calls and puts we are buying, we are trying to buy calls and puts which help us make our Vega almost half, right? So what will happen is, at least in case the Vega starts dropping, you still make some money out of it, but in case Vega starts increasing, it's not going to hurt you much. And why it will not hurt you much? Because reason number one, you have already reduced your Vega exposure by 50%, plus on top of that, you are doing you are doing a option strategy where you are selling options where time becomes as your friend. And since time becomes as your friend, even if Vega is increasing, the time will be paying you, which can to some extent take care of that loss which you're making on the Vega. So that is why we are reducing that Vega, so that at least time value can help us in some way. So what are these strikes? The anchor unit is at or above the distal line, which is the stop loss of the at or below the distal line of this distal line, which is the stop loss of the demand area, and similarly the anchor unit is the at or above the distal line, which is the stop loss of the supply zone, and the offset units are above the call we sell and below the put we sell, and we want to find something which is almost half of, which has vega, which is half of the anchor unit. So what is going to be the maintenance? Maintenance is if any of the stop loss is hit, right? Whether it goes above our supply zone or below our demand zone, if the stop loss is hit, you close the position. If any of the short units, they start trading less than 10% of the premium received, you can still close it. And yes, we can also evolve it in case the section changes for IV. Now let's look at it as an example. If you remember, we also took the same example for short strangle when we were in March, and you can see in the month of March, when we talked about our demand areas and supply areas, the March expiry was within this range. So if the March expiry was within the range, and if we would have applied any of these non-directional strategies, we would have made money irrespective wherever the prices might have been at the day of expiry. So if you go through the previous session where we did short strangle, you will see we marked the same areas, and you can see, the month of March we expired within that range. So let's assume we have a supply zone which is starting at 14,919, and your distal line is somewhere above. So what is going to happen? My out of the money call will be 15,100, and my demand zone is right here. So here my out of the money put will be 13,600. So first you need to have a quality demand zone, you need to have a quality supply zone within which we are expecting prices to remain till expiry. Now once you have identified your areas of demand and supply, the next consideration is that my IV should be in section 4. Now, once your IV is in section 4, what do? We sell the anchor unit, which is our 13,600 put, and we also sell the anchor unit, which is 15,100 call. So we sell this call, we sell this put. So this is above the supply zone, this is below the demand area. Now, when we do this, if you look at the payoff graph, and if you look at what is happening here, you can see by selling this call, which is 15,100, we collected a premium which is 196 rupees, right? We can see right here. And similarly, by selling the put, we collected a premium which is around 32 rupees. So what is the total premium you collected? You can see we collected around 228 rupees, right? So you collected a premium, so that is why it's a credit strategy. You collected 227, but this is what we call as a short strangle. So you can see if prices, they start going down. Let me change the color here. So you can see if the prices, they start moving down, you have unlimited risk. And similarly, if the supply is violated and prices they start moving higher, you have unlimited risk, right? So that is what you can see. You have unlimited risk potential. And these are your break-even points. So what are your break-even points? If you look at your break-even points, you can see my short call, right, which is 15,100 plus the premium which I have collected will be the upper protection point, which is my 15,328. And similarly, if you talk about your lower protection, it is going to be my short put strike, which is 13,600 minus the premium we have collected. So these are your break-even points, which you can see right here. So if till expiry price remains within this range, yes, you make maximum profit. In case it starts moving down, you can even have unlimited loss. That is what a short strangle is all about. So now what do? We convert this short strangle into an iron condor. So how do we convert it? Again, it's the same demand area, same supply area. We sold this put, which was 13,600 put, out of the money, and we also sold this call, which is 15,100 out of the money, and we collected some premium. So what do we do now to convert it into an iron condor? We will buy a call which will be above this, right? And that call should have vega, which should be almost half of what we have for this short unit. So what I did here is I added an offset unit which will be 15,600 call, and since this is 500 rupees higher, I will also go 500 rupees lower from here. So the distance should always be equal, right? So if you're going 500 above, you should go 500 below. So here 500 below will be 13,100 put, and you can see when I add to this, so initially you can see that this is what we were having. In fact, let me go back. We didn't touch upon few of the things. So if I go back just a second, so you can see what was happening here was, if you look at your your Vega was around 19, right? So here we were having an exposure of 19 when it comes to Vega. Theta was definitely helping us. We are making around 9 rupees for keeping the position overnight every day. But here you can see a Vega exposure is almost 19 rupees. Now, when I converted it into an iron condor, so what you can see, first thing, yes, we did collect a premium which was 200 and something. But now to buy this out of the money call and to buy this out of the money put, I also paid some money. You can see I paid 44 rupees 65 paise and 15 rupees 45 paise. But even after paying this, can you see initially it was 200 something, but I still collected a premium of 167. So I'm still collecting some premium. But now the advantage is, can you see, now it became a strategy where my risk is also limited. So in case it gaps up or gaps down, I will not be having unlimited loss. And now if you look at your Vega, you can see initially, when we were doing the short strangle, our Vega was somewhere close to 19, and now you can see we are almost close to half of it, right, which is 8. So what is going to happen now is, in case the volatility increases, it's not going to hurt me a lot. Why? Because we have reduced it by 50%, but you can see this Theta is still paying me, because the value of Theta will also go down, but I'm still getting around 4 rupees paid from this. And this is what an iron condor is all about. So what you do is you add the offset units. By adding those offset units, you make this strategy as limited risk and limited reward, still collecting some premium. And again, if you talk about your break-even points would still be the same. Whatever is your strike, which is your 13,600 minus the premium, and similarly 15,100 plus the premium. So those are your break-even points, and as long as prices they remain in this range, you are making the maximum profit, right? So now we just converted an short strangle into an iron condor by adding the offset units, and this is what iron condor is all about. So that is what I was talking about last time. It's not anything different from what we were doing. It's just that we are now adding some offset units to it to convert the unlimited risk characteristic into a limited risk characteristic. And perfect, that brings us to the end of today's session. A very quick session today, because it was nothing out of the blue. It was something we have already covered. We were just adding the offset units to it. So again, I'll add, if you have any questions, queries, feel free to put it in the comment section. I'll try to answer them as soon as possible. So I'll be seeing you now sometime during the week, where we will cover the same topic in Hindi as well. So till then, trade safe, enjoy your Wednesday evening. Take care. Bye bye.